Today we are covering the taxation of retirement income from pensions and annuities, a critical topic for the enrolled agent exam. The first step in any exam question on this topic is to determine if the distribution is fully or partially taxable. A pension is fully taxable if the employer contributed all the money and the employee's contributions were made with pre-tax dollars. Think of a traditional defined benefit plan. If the 1099-R shows the same amount in Box 1 for the gross distribution and Box 2A for the taxable amount, you're looking at a fully taxable pension. The exam won't always make it this easy. The real test of your knowledge comes with partially taxable annuities, where the recipient has a cost basis, meaning they contributed after-tax dollars. For these, the exam will require you to use the simplified method to calculate the tax-free portion of each payment. Let's walk through a typical exam scenario. A client age 63 begins receiving $1,500 per month from an annuity. Their total investment, or cost basis, shown in Box 9D of the 1099-R, is $60,000. To find the tax-free portion, you divide the cost basis by the number of anticipated payments from an IRS table. For someone age 63, the number of payments is 250. So you take $60,000 and divide it by 250, which equals $240. This $240 is the tax-free portion of each monthly payment. The remaining $1,260 is the taxable amount. An exam trap here is when they give you a 1099-R with Box 2B, taxable amount not determined, checked. This is your cue to perform this exact calculation. Understanding Form 1099-R is non-negotiable. Pay close attention to the distribution codes in Box 7. A Code 7 indicates a normal distribution for someone over age 59 and a half with no penalty. A Code 1 signals an early distribution, meaning a 10% additional tax might apply unless an exception is met. The exam loves to test these exceptions. Common ones include distributions made due to death, total and permanent disability, certain medical expenses exceeding 7.5% of adjusted gross income, and payments to a qualified public safety employee who has separated from service. Be careful with wording. A question might state the taxpayer is facing financial hardship, which is not a valid exception to the 10% penalty. You must know the specific, legally defined exceptions. For instance, an exam question might describe a 50-year-old who takes a distribution to pay for their child's college tuition. This qualifies for an exception if the funds are from an IRA but not from a 401k plan. The source of the retirement funds is a critical detail. This highlights a common point of confusion. The rules for IRAs and qualified plans like 401ks are not always the same. Here's a simple mental shortcut to keep the core concept straight. If you didn't pay tax on the money going in, you pay tax on the money coming out. This helps you remember that contributions to traditional, qualified plans are pre-tax, so the distributions are fully taxable. Conversely, after-tax contributions create a cost basis, meaning a portion of the distribution is a tax-free return of your own money. The exam tests this fundamental principle through various scenarios involving rollovers, plan types, and distribution reasons. Master the calculation for the simplified method and memorize the key exceptions to the early distribution penalty, and you will be well prepared for these questions.